to another session of the Rousseau Report. I'm your host, Dennis Rousseau. Market update, December 2023. Where are we? And are we tracking close to where we've been reporting? Let's find out. Our national debt continues to rise, just as predicted, and is now at $33.7 trillion, an increase of $1.4 trillion in just 6 months. What are we spending it on? Revenue is currently at $4.7 trillion. So yeah, we're upside down and spending like a bunch of drunk sailors. Consumer credit card debt continues to climb and just passed the $1 trillion mark for the first time in history. Existing home sales fell from 6.5 million last year to 4 million in 2023. Result of high interest rates, maybe unemployment. Let's take a look. As we all know, consumer prices continue to rise, and when you have uncertainty in the direction of the economy, people are cautious spending money, and it doesn't matter whether you're making $1 million a year or $100,000 a year. Throughout 2022, weak growth and elevated inflation mirrored the economic stagflation of the 1970s. That ended with a global recession and a series of financial crises. A full 70% of the GDP is consumer spending, so it shouldn't come as a surprise to learn consumer confidence has an adverse effect on markets, all markets. People simply don't have the disposable income. As a result, consumer sentiment fell for a third consecutive month, according to the Consumer Index, which is a monthly survey of consumer confidence with regard to the economy, personal finance, business, and buying conditions. In other words, we're in deep crap, and everyone knows it. For the first time ever, you need a six-figure income just to buy a house. The problem with that is the median income in the U.S. is $78,000. We're facing an affordability crisis with the average 30-year interest rate at 8.09%, the highest in over 20 years. Credit card delinquencies are the highest since 1991, up 60% since last year, and car loan delinquencies are the highest in 20 years. Perhaps just another cycle. According to some reports, office vacancy rates are currently averaging 17%, up 140 basis points year over year. Miami's on the low end of the scale, with San Francisco well over 25%. Now, here's the problem with this statistic and how it can be misleading. When we say Houston and Los Angeles are at 23%, that only takes into account Class A office space in the immediate downtown area. And as soon as you drive out of downtown, you're technically in the suburbs. Now, when you combine the two areas, we have 6.4 billion square feet of inventory, 78 million square feet under construction, and when you consider the number of companies laying off thousands of workers, which I'll show you in a minute, and they're committed to long-term office space. What do? They look to sublease a space, which adds another 250 million square feet to the market. Are we done yet? WeWork filed for bankruptcy in November and will unload 40 million square feet of office space back on the market, with 50% of that in North America. Sounds awfully high until you consider the federal government owns or leases more than 450 million square feet of office space that costs billions to operate, and 75% of that is vacant. 75%. In 2023, the Automobile Dealers Association forecasts new vehicle sales of 14.6 million, based on 14.9 million sold in 2022. We're currently at 13.7 million, and we're in the middle of December. The auto industry caught my eye recently when I began to see ads I hadn't seen in a couple of years. Low financing and cash back. And then it dawned on me, the OEMs don't make offers like this unless sales are in the tank. Then, of course, we have the discounts. $5,000 to $6,000, $11,000 to $12,000. In our last couple sessions on markets, we highlighted the number of layoffs that were happening across North America. This chart depicts the number of layoffs in just the first 2 weeks of November. Note, Maersk Shipping, the world's second largest container shipping company, with over 700 container ships, laid off 10,000. And that's not because business is on the rise. While we were compiling these statistics in November, Lloyd's of London just announced 2,500 layoffs. Barclays, 2,000. JP Morgan closed 160 branches. How many people does that? 1,600? TD Bank, 3,000. Hasbro, 1,100. US Steel, 1,000. VF Corp, 500. Remember, consumer confidence has an adverse effect on markets, all markets. On a global scale, Germany, which boasts the fourth largest economy in the world, is struggling to tackle a budget crisis that threatens to exacerbate problems in what's the world's worst performing major developed economy. Exports are down, inflation's up. China's real estate industry is underwater. Prices have been falling for months due to weak demand. In addition, Chinese real estate developers are defaulting on debts and struggling to finish projects. If you recall, Evergrande, China's largest property developer with over $300 billion in liabilities, was given until January to reach a restructuring deal, otherwise liquidate. Youth unemployment in China is over 20%. They've tipped into inflation in recent months, another sign of weakness. Is there any question that we're in a recession? Higher interest rates will continue to weigh on the global economy in 2024. Home prices, auto and retail sales will continue to decline, and unemployment will rise. Now, how does this parlay into business jet markets? Let's turn to AircraftPost, the global leader in market intelligence. Over the last few months, there were a couple inquiries regarding the disparity in AircraftPost value versus selling prices. So let's add the average selling price over the last 6 months for each year model for clarity. In this case, we'll use a 2007 Global XRS that shows an average selling price of $17.2 million versus an average value $11.7 million. And now the correction. An average ask price of $16.1 million. Are prices calming down? You bet. When ask prices fall below the average selling price, we're experiencing a market correction, which is also reflected in available inventory. Year over year, Q4 results from 2022 to 2023. Inventory is up twofold. This chart depicts current gen models. What about legacy aircraft? The G5 Global Express, the G200 Falcon 900EX. Once again, inventory has increased over 100%. Is history repeating itself? In 2008, during the last market run-up, average selling prices showed an increase of 24%. The same increase in 2022. It was a dramatic drop in 2008-2009, whereas today we're seeing a more gradual price correction. This particular 15-year-old G550 should be selling for plus or minus $12.5 million based on year-over-year market depreciation. And the fact 2008 year models were selling for $18 million in 2017 and $14.5 million in 2020. Another data point we consider when making statements on pre-owned markets is that of transactions. These aircraft models are all very capable aircraft for the respective categories. There's a nice selection on the market, yet zero sales in the last 6 months. What's it going to take to sell these? As of December 15th, our markets are showing the highest inventory levels on record, 20% greater than seen in 2022, and I believe we're going to break 1,500 by year end. Conversely, transactions are on par with 2022, but well below those in 2018, 2020, and 2021. Another data point that's contributing to a market correction is that of days on the market, going from an average of 79 in 2022 to 171 year-to-date 2023. How are new aircraft deliveries doing? About 10% below 2022's numbers. There are some models that are showing a year-over-year increase in deliveries. The Global 6500, CJ3 Plus, XLS Plus, PC24, but none are beating the records set in previous years. We're going into 2024 with a lot of questions and concerns about the economy, as well as our business jet markets. And as always, we'll be sure to keep you posted. I'm Dennis Rousseau from the Rousseau Report. See you next time.